All right, let's talk about a fascinating company called ChemoMetec. Now, this isn't just another story about some complex life sciences company. From an investor's point of view, this is a masterclass in how to build an incredibly profitable and, maybe more importantly, an incredibly well-defended business. So let's just dive right in. I want to start with a question, because it really gets to the heart of what makes this company tick. What if your biggest customers couldn't leave you? Not just because it was inconvenient, but because switching away from your product was so expensive, so risky, and so tangled up in regulations that it was practically impossible. Well, that's the world ChemoMetec lives in, and it's the key to understanding this whole story. So, how does this company generate these kinds of profits? Well, it all comes down to a really simple, really elegant business model. Let's break down how this money machine actually works.
It is the classic razor and blade model, and they have executed it perfectly. First, ChemoMetec sells one of their high-tech cell counters. That's the razor. This gets their instrument inside a lab or a manufacturing facility. But the real genius, the real magic, is step 2. For every single test that customer runs, they have to buy ChemoMetec's proprietary single-use cassettes. Those are the blades. And that creates this incredible, long-term, high-margin river of recurring revenue that just keeps flowing, long after that first machine was sold.
Now look, a great business model is one thing, but you gotta be able to protect it. And ChemoMetec has built what you could basically call fortress walls around its business. This is their competitive advantage, their moat, and it is wide and deep. So these walls are built from a few different things that all lock together. Yeah, the technology itself is proprietary and it's easy to use, but the real power comes from how deeply it's woven into regulated manufacturing processes. See, their instruments are compliant with super strict FDA data rules, and that is what creates these insane switching costs for customers. To really get why this is such a powerful lock-in, you have to understand these regulations. GMP and 21 CFR Part 11, they aren't just suggestions. They are the law for drug manufacturing. They make sure every little piece of data is secure, it's time-stamped, and it can't be messed with. And ChemoMetec systems, they were built for this from the ground up. And this quote just nails it. For a drug maker, a ChemoMetec counter isn't just a piece of equipment. It becomes a validated, official part of their manufacturing process, the one they filed with the FDA. So if they wanted to switch to a competitor, oh man, they'd have to revalidate their entire process. It's a hugely expensive, time-consuming nightmare that nobody wants to take on. So for all intents and purposes, they are locked in. Okay, so this all sounds great on paper, right? But how does a model like this hold up when things get really, really tough? Well, the industry downturn we saw from 2022 to 2024, it gave us the perfect real-world stress test. You might remember this, the so-called biotech winter. It hit the industry like a ton of bricks. Funding just vanished, and ChemoMetec's customers, especially those smaller biotech firms, they just slammed the brakes on buying any new equipment. This was a direct assault on the razor part of their business model. And the results of this stress test, wow, they were really telling. Just as you'd expect, instrument sales, the razors, they plunged 17%. But, and this is the proof of the model's strength, customers couldn't just stop their ongoing work, so they kept buying the high-margin blades. Consumable sales grew a jaw-dropping 18%, and services jumped almost 40%. That recurring revenue acted like a giant shock absorber. So what this proves is that the huge number of instruments already out there in the world, what we call the installed base, it creates this incredibly stable foundation for the business. It makes ChemoMetec way more durable than a company that just sells one-off pieces of equipment. The storm came, and the fortress walls held strong. So with its resilience proven, ChemoMetec isn't just sitting back and defending its fortress. Oh no, it is launching its next campaign for growth. Let's take a look at what they have planned. The company is really pushing forward on 3 main fronts. First, they've got this new cytometry platform, which is aimed at bigger, higher volume customers. Second, a really smart strategic acquisition of a company called Ovisio. And third, they have a whole product pipeline aimed at even more automation. And that Ovisio acquisition is a huge deal. It's so important because it moves ChemoMetec's technology even deeper into the manufacturing process. You see, their traditional business is at-line quality control, where you have to physically take a sample out to go test it. Ovisio's tech is in-line. It connects directly to the equipment for continuous real-time analysis. This is a game changer. It moves ChemoMetec from just testing a product to being a critical part of controlling the entire process. That's a much stickier place to be. So let's recap. We've got a fantastic business, a powerful moat, and some very clear paths for growth. All of this brings us to the final and maybe most critical question for any investor. What is the price of admission for this kind of quality? Before we even look at the valuation, we have to frame this company correctly. ChemoMetec is what's known as a cyclical grower. Basically, it rides the long-term growth wave of biotech, for sure, but its short-term results, especially those big instrument sales, are always going to be tied to the boom and bust funding cycles of the industry. And, look at this. The difference becomes just staggering when you put ChemoMetec next to its peers. It's not even a fair fight. It trades at a valuation over 10 times higher on a sales basis. And you can see why right here. Its EBITDA margin is a massive 48%, while its peers are barely profitable or even losing money. It's playing a completely different game. And this is exactly why you cannot value ChemoMetec like it's just some generic lab equipment company. A much better way to think about it is to see it for what it truly is, a high-quality niche monopoly. It dominates its space, it has a captive customer base, and it absolutely prints cash. But that kind of quality, well, it comes at a price-to-earnings ratio of around 60. That's the premium, that's the steep price the market is demanding for the safety and the durability of this company's earnings. And this quote just sums up the bull case perfectly. Investors aren't just paying for 1 or 2 years of growth. They are paying for what they see as a highly predictable, highly profitable stream of money that's going to last for years and years to come, all protected by that incredible competitive moat. Which leaves us with the ultimate question, doesn't it? There is absolutely no doubt that ChemoMetec is a best-in-class company. It's a true outlier. But for an investor looking at it today, the decision really boils down to one simple thing. Is paying this best-in-class price for this best-in-class business the right move? And that, right there, is the billion-dollar question.